Okay, let's look at exercise 8 on page 403 of your book. This is where we're going to apply the lower of cost or market. So here we're looking at a problem where we're going to adjust inventory. So from your reading, you'll remember that when we price inventory, originally when we record the journal entry, it's our cost, what we paid for the inventory. That's what's recorded on our books. Well, now we've introduced this principle where we're going to want to apply the lower of the cost or market rule. This is where we want our inventory to be whatever is lower, what we paid for it or what we can get on the market for it, what the current replacement cost is. So if you see current replacement cost or cost, or fair market or market value, those mean the same thing, okay? So in this example, it says, assume that a Rocket Burger restaurant has the following perpetual inventory record for hamburger patties. So we've got some purchases, we have some that were sold, and we have some inventory on hand. It says that February 28th, the accountant for the restaurant determines that the current replacement cost of the ending inventory is $447. So make any adjusting entry needed to apply the lower of cost or market rule. And what would merchandise inventory be reported at on the balance sheet at February 28th? So let's look at your Chapter 6 working file. So here it says, on February 28th, our merchandise on hand here is $400, okay? So this is $400. That's the balance. So what I'm going to do is I'm going to look at my file here, and I'm just going to make a T account. All right, I want to make a T account showing the balance in my inventory account. So here's my inventory account, and it said we have 400. And I know it's on the debit side because inventory is an asset. Assets increase with a debit. That's the normal balance. And so they say the current replacement cost is $447. Well, which is lower, $400 or $447? Well, for this problem, what we have on our books is lower. So there's no journal entry. And the balance on the balance sheet will be $400, okay? But how about the market? So this is if the market value is 447, okay? What if, say, the market value is 350, okay? Well, that's lower than our inventory on hand right now, right? So I would want my inventory to be 350. So that's what I want in the balance. Well, to get it to be 350, I know I'm going to have a credit over here, and I'm going to have to credit $50 to my inventory to make it 350 because that's what the market value is, and it's less than my cost, and that's what I want it to be. If I have to make a journal entry, I know I'm going to credit inventory for 50, and think about what you think the debit's going to be here. All right, anytime we sell our inventory, where does the cost of our inventory go? What do we record? We record cost of goods sold. So anytime I'm making an adjustment to my inventory, I'm always going to run it through cost of goods sold. So this would be the journal entry if the market value is 350. Okay, so if it was less than the balance on my books. And then here, my balance sheet would show a balance of 350 on the books. Okay, so if you have any questions on that, send me an email or let me post your question in the Chapter 6 question forum. Okay.